All right. We're back with another podcast today. We have a fantastic guest. We've got Carson Porter, who is the COO of XRP Legacy. Carson, thank you for joining me.
Yeah, thanks for having me, Jake. I'm glad to be here.
Absolutely. So really excited to get into what we're talking about today. We have a lot of clients that have come into larger amounts of wealth with crypto.
Yeah.
And, we help them structure their estate. We do a lot of the wealth management for them. But a big portion of legacy planning and continuity is life insurance. And so really excited that we're able to come together on this and kind of provide people some value on it. But I'd love to start with your background in the industry and just kind of how you ended up where you're at today.
Yeah, so I've been in the industry now for almost over 12 years now. Started as an agency owner for a captive multi-line firm based actually here out of Texas, and built up a good agency there, had a good time. We were their number one firm for 5 consecutive years.
Wow.
Ended up leaving and starting my own brokerage, and then we moved into what's called FMOs and IMOs and launched training programs. So our current platform, we've got about 6,000 agents across the U.S. and Canada, primarily, that we teach and train how to sell more life and more annuities, more ethically, more profitably. I won't give you the whole spiel, but we do that. And then on top of that, I've continued to run my firm and most recently have partnered up with Azure to help bring their game to a whole nother level when it comes to really advanced planning for high net worth and even ultra high net worth individuals. They've got a solid program for Ma and Pa, but now we're pretty excited to be able to bring all those other key pieces for, like you say, the players that are coming into new money. And the thing, you've seen this, old money already has SOPs. They know what to do. They've already got the team. But the folks with new money end up getting, for lack of a better term, screwed out of it. Yeah. Oftentimes by the IRS or their family members or whatever, just because they don't have the team in place. So,
yeah, you want good professionals around you. So we work with a lot of Gen 1, like you mentioned, the matriarch or patriarch that's had a large exit in their business and they want to make an allocation to digital assets, or they've come into money in crypto and they're wanting to figure out how they can mitigate taxes and structure things the right way to protect it, right? So that their next gen of their family office continues to be able to benefit from the investments that they made and all the hard work that somebody put in early on. So what do you see most often? So, we do a lot for term policies. We'll do whole life, structure things for annuities that allow people some income. But when you get into that more advanced estate planning with an ultra high net worth individual that's come into, we'll just give an example. Well, you know what? It'd probably be better if you give an example. Do you have somebody that you've worked with recently that's, had a large exit in a business that you've helped structure things the right way?
Yeah. We've got lots of examples, so many angles. So what's interesting is at the end of the day, at its core, when we start doing life insurance at that level, we're using oftentimes the same product. We're using a lot of the same structure and the same basic principles. We may be able to go in and flip little, different switches in these policies that aren't available or aren't on the market at a smaller level. To do some really neat things inside of those, like non-commissionable policies where, your big fee package as a part of the policy isn't eaten up in exorbitant commissions. Agents are still getting paid and taken care of, but at some point we need to, tear that back to maintain the integrity of the plan. So there's all sorts of neat things we can do. A recent exit from some clients. So we actually were working on a very interesting one. They had a large exit, about $20 million. And they'd gotten some advice that they were going to set up some deferred sales trusts.
Yep.
And then,
common.
Yep. And then fund in some cash value life insurance into those deferred sales trusts. We actually ended up not following through on that plan.
Okay. Interesting.
We moved into actually working with some annuity products. Because they already had some red flags as a part of their planning process and where they were at, they didn't have any of their plan in place ahead of time. So it was all very reactive instead of proactive planning.
That tends to be the case. People don't, they're excited to make the money, but how long before you have an exit should you start thinking about this stuff? 6 months? Is that a long enough time frame or?
Yes. But I also think you should start thinking, if your plan is to exit, you should start thinking about it. Because there's some really neat pieces that if you already have it in place, you don't have to put in all that work right then and lose out on a lot of opportunity. So life insurance policies, annuities, we have convertibility of ownership, right?
Right.
Your corporation can own the policy. You can own the policy. We can move it into your estate. We can move it into an ILIT, an irrevocable life insurance trust. So now we can hold it at arm's length and not increase the value of your estate. So you end up paying a whole lot more in estate tax. There's a lot of neat things we can do. And if the policies already exist, it's infinitely easier. So those policies and the utilities we use those policies for, I think that if any business owner or any entrepreneur, anyone who's planning on coming into money has a hope for or a desire for an exit, they really ought to start putting some pieces in place. And we can find useful utilities for that policy right now. And down the road, we can convert that policy into something else that is more useful at that time. And so, yeah, I think when you're coming up on exit, 6 months is like a minimum for ethical planning. I think the sooner the better. Okay. And all it does is increase how effective we can be with whatever solutions we're bringing to the table. But with that group, the reason we actually moved them out of a cash value life insurance product, we ended up helping them with some other life insurance product in there, some permanent life insurance that doesn't have cash value, has a much lower cost basis. Okay. But that's going to help fund some future estate tax issues that they may have. Okay. Because they haven't maintained entity concept very well. And so their trusts we're worried about them.
Commingled a little bit.
Yes.
Yeah, that's pretty common.
Yes. So between that and some of the other red flags, that's actually a great piece we were able to come in with, was to come in and say, hey, let's not reinvest those dollars into cash value life insurance. Let's mitigate some risk that you have with cash value life insurance and maybe pass money on effectively through some life insurance. But let's use some annuities instead, and that's going to keep them off of that IRS Dirty Dozen list and tripping so many more red flags for them and creating more complications down the road.
Yeah, so we work with a lot of clients, and we'll structure like a term policy today that's convertible to a whole life later on. So, if you are going to have an exit at some point, you talked about, you're just going to have more opportunities if you have something in place. A lot of our clients may be healthy today, which is great. So if you get stuff underwritten early, then that's the health profile that they're going to use for later policies. Is that right? So
right, yeah. So policy convertibility is huge. We just worked on a case I think you're somewhat familiar with. Yeah. And individuals young, healthy, worth a lot of money, and has an existing estate tax issue that we really need to put a buffer on with some life insurance. So we're putting tens of millions of dollars in place now through a term product because it's cheap. Yep. We can get it done quickly and it fits what that person has going on right now. Well, that person is already looking at some large exit opportunity here in the next couple years. And what we'll be able to do is convert that to what we call loan regime split dollar. And we'll be able to help that individual move over the course of about 10 years. He'll be able to move out $20 to $30 million, closer to $30 million, and service, instead of standard taxes, he'll be able to service his tax obligations at like 4.5 on what we call AFR, annual federal rate, instead of income tax at 37%.
Wow.
That's huge. Cool stuff.
Yeah. I don't think people are just, we have a wide variety of people that watch this. And some of these terms are going to be hard. Yeah. Like if you're not familiar with the industry, right? So like there's different components of an insurance policy, the owner, the beneficiary, and you can also like trade the ownership to other people. I see people that like sell their life insurance policy. There's a lot of stuff that's around that. Is that ever beneficial? Or would you rather loan against the cash value as it accrues in the policy?
So gifting policy, there can be some taxable implications as you take, if I have a policy with $1 million in it and I give it to somebody, they're going to have a taxable implication because they just came into $1 million. Keep in mind, cash value life insurance is not a qualified plan. Okay. Or it's not a
it's
plan.
Not tax deferred.
Yeah.
Got it.
Yeah. Well, and so it's after tax. There's no real way to hide it. We don't get like a stretch IRA provision or anything like that, which really doesn't exist anymore anyways. But we don't get some of those affordabilities that we get with some other plan types. But there's still a lot of times where it makes sense to convert ownership. Like, for example, that one individual that I was telling you about. Right now, it makes a lot of sense for that person to own their own policy, tens of millions of dollars of life insurance as a term policy. But when we're ready to start moving millions of dollars out of that person's corporations into their own estate, we don't want to create huge estate tax concerns.
Right.
So we're going to create an ILIT trust, an irrevocable life insurance trust. And at that time, that life insurance trust is going to become the owner of that policy. That person will be able to gift it over. So there are times where it makes a lot of sense to gift the policy. And then there are times that it doesn't. Life insurance death benefit proceeds are tax-free. As long as we haven't violated any tax law, they're tax-free. So if I want to give my policy to my children, the best thing I can do is kick the bucket.
Well, yeah. Well, and we know we're all, going to come to that point at some point in the future, unfortunately. But, and that's what you're planning for, right? Like it's tough to deal with mortality, and a lot of people don't want to talk about life insurance. But I think, if you have beneficiaries, if you have people that depend on you, it's kind of your responsibility to put something in place that's going to soften the blow when that happens. You never replace the individual,
right?
But if you can help out the next generation or the beneficiaries or the business, whatever might need some cash in a situation that wouldn't have, like, if you've got to go through the estate process or probate, or, a lot of people are using trusts alongside this to mitigate the probate and gain, creditor protection if they're structured the right way. But this provides another tool, another avenue to really pass that large sums of money to the next gen or the beneficiary tax-free.
Yeah, and that's when we get into planning with those that have a significant amount of wealth. Those are some of the bigger reasons. They do want to pass that wealth into the next generation efficiently, but you can do a lot of that through corporations and trusts.
Yeah.
However, the corporations and trusts tend to create a kind of a clunky structure because of the way probate works. And so when we add life insurance, if you're worth 50 million, you don't need 50 million of life insurance.
Right.
But having 10, 20 million of life insurance, what it does, it creates a probate protected and tax-free liquidity event right then and there. And those funds are mobile.
Right.
And that sometimes is the difference between the businesses you're leaving behind continuing to thrive or not. Probate can, especially if folks want to fight.
Things up. Oh, yeah. Yeah, it can be an extended period of time before those funds actually get to who they need to get to in order to continue operating, right? So a great, tool for that. Do you see a lot of business owners use this as a line of credit?
Yeah. So there's that term out there, infinite banking, right? And there are some folks that love it. There are some folks that hate it. At the end of the day, it's just cash value life insurance as a tool. And they'll build up their own line of credit. That line of credit, it's not making huge. You're not going to see a 300%, gain overnight. You're going to see consistent 4, 5, 6%. It's a nice bond alternative, so it de-risks your portfolio a little bit. And most of the most of the leading authorities do agree that cash value life insurance can be a viable bond alternative. So that's where we see it. But what's nice is now we can put that money there rather than, say, a bank account. We can get all these different tax leverages like we've been talking about. We get death benefit leverage. If I put 10 million in it, then I'm probably going to pass 20 million on at some point. I get all these different levers in that account. Plus I'm getting, like I say, 4 to 6% per year in a fairly safe fashion that allows me to de-risk my portfolio and keep going hard at the things that are making me money.
Right. Well, so like, again, a large portion of our clients are crypto, right? They have made significant investments in certain digital assets, and they expect those to go exponentially higher as this, technology is adopted and implemented.
Right.
And so alongside that, we work with them to be able to help them mitigate risk and then diversify post-price appreciation in tax beneficial ways where they don't have to necessarily liquidate the asset and deal with, huge tax consequences. And this seems like a really good way that you could structure stuff to diversify, like you mentioned, into bonds, but without some of the additional tax implications that the bonds would have later on when they matured.
Right.
This would, continue to grow very consistently over an extended period of time. And again, I think it's a good way to diversify.
Yeah, it's a great way to diversify, and then it's a great mobilizer. One of the hardest parts about making money is getting your money out of the thing or out of the place that you made it and into your own estate, into under your control. That's very difficult because Uncle Sam is sitting there with his
hand out.
Yeah, with his hand out. And so what's really neat about life insurance is it becomes a very effective tool. In fact, one of the most effective tools to be able to make that happen. And so a lot of times folks are like, well, life insurance is expensive. Taxes are much more expensive. Right? And so it's give or take what do you want? But we can do some other cool things through cash value life insurance as well. We can help business owners and investors through what we call cash balance plans and non-qualified deferred compensation plans. Folks who normally can't put money into a 401k or an IRA, or if they can, it's such an insignificant amount.
Right.
But we can help them defer taxes through cash value life insurance on millions per year if needed. So there really is, depending on the circumstances and can the person qualify financially, not necessarily health-wise, but there's almost no limit because it's a non-qualified plan. We kind of get all the glass ceilings removed, and that's pretty cool.
Yeah, that's incredible. So if you had large amounts of income off of your crypto, let's say, you staked it somewhere, or, we're rolling out some products that I think will be lucrative for people over the long term. If you have that consistent cash flow, it's income, right, to your estate. And you could take a portion of this and fund this policy and defer those taxes. Is that?
You could defer a portion of them, and it wouldn't be just the policy, right? Every good policy is part of an even better plan.
Right.
And so in setting this up, usually we're going to have some corporate and trust structuring. We're going to work with a family office and or other financial professionals like your accountant or your attorney to make sure we're getting all the right layers in place, because the policy is just one piece of it. It's the plan that really gets it done.
For sure. And I think it's just, again, this is just a piece of your total wealth planning, right? So we do the wealth management for people, but I think a lot of people, they don't think about the wealth planning. When you have assets that are going to appreciate, 10, 20, 100x over your lifetime, maybe more, if you're in crypto. If you're in a business, that can be realistic over a duration of, 10, 20 years if you're scaling something. So there's just a lot of tools here that I think people may not really know about. When you're structuring things for, let's call it a, ultra high net worth individual, somebody that's worth more than 50 or $100 million, where, like the ILET, what are the most common things that you have seen used in that situation? And if you could break down, maybe some of just give a high level of what each one is.
As far as different strategies, or
well, we'll start with the ILET, and then you can kind of talk about some other ones that you think you've seen.
Yeah, so ILETs are phenomenal. It's an irrevocable life insurance trust, and what an irrevocable life insurance trust allows you to do is not exceed those estate tax thresholds, which are
30 million next
30
year,
million,
15 per person, or 30 for a couple.
Right. But if you're worth 30 million and you have a $15 million life insurance policy and it's paid direct to your estate, now your estate goes to 45 million. And guess what? 40% of that is
straight to Uncle Sam.
Yeah. That's massive. So we do want the big liquidity event and the mobilization of money that life insurance gives us, but we don't want to lose 40%.
Right.
That's what an ILET guarantees us. It guarantees us that as long as we don't pierce that veil, as long as we follow the rules, we're able to take that policy, put it inside, and it's now considered not part of the estate. So we still have trustees, and we can control those funds from beyond the grave, and not just beyond the grave, but while we're living through our trustees and grantors. But we don't put ourselves at risk of having that massive, massive tax hit. So ILETs are phenomenal for that. Deferred sales trusts have been absolutely massive in, forgoing capital gain for now, so that we can reinvest those monies. And we're going to have to pay something as we receive some dividends, but it allows us to control when and how we're being taxed so much better. And through deferred sales trusts, we've done lots of life insurance, but we've also done lots of annuities. Annuities have been a phenomenal way to structure incomes coming out of deferred sales trusts. And our clients have really appreciated, again, the de-risking, so that at least on a portion of what they're doing, so that they can continue to not just preserve wealth, but continue to go grow wealth.
Right. So I think a lot of our clients, because crypto is their expertise and where they've made their money, they're probably going to stay in that lane. And I do think the risk in that asset class will come down after we see regulation. The underwriting on a lot of loans and leverage against it will come down. But if you are going to play in something that's riskier, like, growing a business or more in risky investments, would you be able to use a deferred sales trust with crypto? Like if you were to sell off some of your crypto, or does it have to be a business transaction?
It doesn't have to be business transaction, because you can use deferred sales trust on real estate. Okay. So on crypto, I'm not sure. I don't know that I'm the expert on that.
Well, we'll have to roll that around, because I think there's going to be some people that do want to take large portions of profit for whatever reason. We advocate that a lot of people just hold the asset over their lifetime and continue to receive the upside and appreciation on it. Have you seen anybody, kind of blend life insurance with digital assets, or is that still on the horizon?
I think it's a little bit on the horizon. So that's good news, though, because early adopters are the ones that come out best.
Right.
And especially with life insurance has such unique and such robust tax favorability that the Uncle Sam, the IRS, they are incessantly trying to tear down some of the provisional and statutory laws we have that protect or give us all these cool tax protections. Yeah. So we've got groups like NAFA and FinSECA and all these groups that are always out there countersuing the IRS to keep their hands out of it. The reason I bring that up is, as an early adopter, not statute, that's not the precedent.
There you go.
Is that when if it was the law, if it was legal, if it was a thing to do,
you're grandfathered in.
You're grandfathered in.
There you
go. And it may go away down the road. And so I think crypto is one of those pieces that it's been around for a while, but it's still so new to the regulatory committees. We don't know what we're gonna see with it. But again, to the point, I think early adopters are going to go further with it, and we are starting to see more and more and more folks on our end using digital assets to grow their wealth, and then coupling that with life insurance through things like we talked about, loan regime split dollar strategies, and all sorts of other neat strategies that we can use in trust structures to efficiently move that money. We're never going to get it all tax-free unless you just buy a life insurance policy and die. That's tax-free. But we don't want you to die. We want you to live
a long time and be able to leverage it and use it and have control.
Exactly. Yeah. Exactly. So what we're looking at is, okay, well, for a fee, life insurance is a insurance policy. It's a policy contract, and there's fees. For a fee, can we get enough arbitrage on our tax, enough savings to make those fees make sense? And unequivocally, the answer is yes when we do it properly. So we are starting to see more and more people coupling their digital assets with life insurance.
Well, there's a reason that the Rockefellers own an insurance company, right? And it's interesting to me that they've left financial products inside of insurance here in the U.S. to be able to leverage this in this capacity. Other jurisdictions don't have this same benefit. You're not able to marry financial products with the insurance. Is that accurate? We have kind of a privilege here in the U.S. and a few other places.
Yeah, we really do. So, for example, just on product basis, Index Universal Life doesn't exist in Canada. They have a universal life product that allows you to participate in Canadian
stocks or investments.
And investments, traditional like ETFs, some very baseline stuff. And then they have Canadian Whole Life, which Canadian Whole Life is pretty sexy, to be honest.
Okay.
But some of their other product, like I say, they just don't even have the option or the opportunity. And then we have the option and opportunity to do what's called private placement life insurance, where we can it's a lift. There's a lot of work to do.
Yeah.
But we can invest in almost anything we want to invest in if we're willing to put in the work, if we've got a effective path to making that profitable for you, the client. Because at that point, you're not paying an insurance company, you are the insurance company. And that's kind of a really neat concept.
Yeah, so you kind of are your own bank, right? So we've looked at PPLI. In the U.S. and Canada, unfortunately, you can't invest in a PPLI policy or private placement life insurance in kind.
Right.
It's got to be in cash for now. We're going to work on that. But maybe through those other organizations that you said, we can lobby for some things to change around
potentially. But one of the other things we can do, and we're seeing more and more ability out of digital assets to be able to post them as collateral. As digital assets improve, you can probably speak to that much better than I can. But what's really neat is we have a strategy called premium finance life insurance. So you may not be able to purchase a policy in kind, but you can use your digital assets as collateral, like you would use a traditional brokerage account as collateral, and go get a bank to put the money in a policy for you. And instead of you servicing premium, you just service bank debt until the policy grows enough that you can pull a nice little chunk and pay the bank back.
Interesting.
Neat strategy. We really love it. In the right time and place.
Well, I mean, again, there's just so many different tools, and there's a lot of smart people out there that have figured out ways to structure this stuff and maneuver using debt or tax-free income in order to be able to facilitate whatever they were trying to accomplish. We've looked at an IDF or an insurance direct fund, and there aren't really any crypto products on the market. Sally's and Spearhead are the two marketplaces for that. So that may be something that we see in the future. We have seen some people structure things offshore where they are able to move the assets in kind for the digital assets. So for people that watch that are international, you and other people that you're aware of have the capability to help them structure that type of policy?
Yeah. There's a little more selective carrier base that's willing to do business out of like the Caymans or Bermuda or other places like Tokyo and Frankfurt and Singapore are big epicenters of opportunity. So we get a little more limited on our carrier base when we do that, but there's still a lot of opportunity. And again, when the juice is worth the squeeze, we've got all the tools and team to make it happen. So
I love that, man. Yeah. So when they're underwriting something and giving you a loan against the cash value of the life insurance policy, obviously crypto would be probably a lower LTV at this point. They probably wouldn't give you as much money on it, and the interest rate would probably be a little higher. Is that accurate?
Interest rate is a lesser concern. Interest rates we're usually going to get, and they'll use several calculations. Some banks want to use LIBOR, some want to use Ameribor, plus a bank spread. Some use other factoring systems. But usually on interest, the underlying asset or what we're providing collateral with doesn't have as much impact there. Loan to value is the big one.
Okay.
And that may or may not make sense. So we did a premium finance deal with a family that we work with. They're worth about $6 billion, and really great family. They're Middle Eastern descent, and trying to passport money between countries can be very difficult, especially when those countries aren't getting along at the moment. So they had a large liquidity concern here in the States. But they had some really large projects they wanted to get on. And so what we were able to do actually was through premium finance life insurance, we were able to get money into cash value policies that they were able to loan themselves back out, and we were able to open up that liquidity. Normally with premium finance, the money in the policy is the collateral or is part of the collateral, so you can't touch it. We were able to get them access to the majority of the funds that were put in the policy by the bank right away, by using non-traditional assets. They were using fine art. They were using large tracts of raw land here in the United States, and the LTV is really, really low on that stuff. But they had large tracts of land sitting there doing nothing. So, if they post that as collateral, it's not going anywhere. They're not servicing debt on it. They were fine. On their fine art, again, they're not servicing debt. It's sitting at Bank of New York as a curator. Cool, we'll take a low loan to value on it just to monetize that. And we were able to get them tens of millions of dollars through this strategy to go mobilize a project that they were north of $1 billion in revenue on in 12 months.
Oh, wow.
So that was really cool.
Yeah, that's fantastic. So, there's going to be a large swath of people that watch this later on. And, you might be international, you might be domestic here to the U.S. It sounds like you can really help irrespective. I want to pull it back for a second because we only have a little bit left here, and touch on the IUL that you mentioned earlier. So I've set one of those up for my son, working on it. And I think that that's a really interesting play, especially if there's a longer time horizon for your children or your descendants to be able to fund that policy up to a certain point, and then it just continues to grow, and it gives them leverage outside of your estate or what you're going to pass them to have liquidity when they want to do something, whether it's buy a home or pay for their college or start a business, make some other investments. Do you see that is a common thing with high net worth individuals using that specific product, or there's some other options as well?
Yeah, we see that. We see whole life as well equally. In our industry, there seems to be a lot of headbutting over whole life, universal life. I think they're different tools in the toolbox, and it really comes down to what's best going to serve that client's wants and needs and their time horizon. I have some index universal life insurance policies on my boys, and I have some whole life policies on my boys. They are there to do different things. Those whole life policies are infinitely more liquid now, but the roll up on those policies down the road, if they don't need that liquidity, is not nearly as great as the index universal life. And so we do a little bit of both for them.
Yeah. So if you're looking for liquidity sooner, you wanted to borrow against the cash value in the policy, say within the next 24 months, probably better to do a whole life policy?
It can be. It can be more secure. If you're a savvy investor and you're willing to service your own debt, because it is your own debt, you're loaning yourself your own money out of your policy, and you can do that at 0% interest if you want to.
Oh, wow.
But when we do that, that can affect policy performance. And in those IULs, those early years, we need policy performance.
You need compounding. You have to have,
So if I'm going to use the money in early years and I'm willing to service my own debt, I'm willing to charge myself 5 points on my own money so that policy can stay healthy, then I have no issue with it. But if I have a client who's not willing to do that, then I think whole life is a better option.
Okay. No, that makes a lot of sense. So, the people that we're working with, again, they probably want access to liquidity sooner than later off of their investments, and they want to, structure things and mitigate taxes. So I think a lot of people, the matriarch or patriarch, probably are going to set up more of a whole life policy. And then if you have a longer time horizon for when somebody's going to need liquidity, the IUL probably makes a little more sense, unless you're willing to underwrite that debt, like you said.
Yeah. And there's some other considerations as well. The IUL is infinitely more flexible. We can increase it, decrease it, do all sorts of things. The whole life policy, once we set it, it's locked in. That's the contract. So we can't do much from there. So if we need flexibility, then we look more towards a universal life product. The whole life product, because it's not linked to any markets, it's an unlinked asset. Banks love whole life, and they like universal life as well, but we get more reach because it's a separate asset class. Mm-hmm. And when you start going to the big banks and asking for big boy and girl money, they really, really like whole life as a separate asset class when they're looking for collateralization, collateral assignments, or even just liquidity in your portfolio. They love whole life. So
well, so again, just so many different tools. Well, I'm going to ask you one more question, then we're going to close here. So, just looking out on the horizon here with all the things that are happening in digital assets and AI and all this progressive tech that's coming along, what are you most excited about in life insurance?
I'm excited about a few things. I'm excited I feel like the opportunities for us to, well, I told you this earlier. Insurance is not sexy.
It can be.
Nobody wakes up in the dead of night and is like, "Oh man, insurance," right? But there are portions to it that are sexy, and with the progression of digital assets, I feel like insurance has a natural place in de-risking if needed, in putting preservation levers on an estate, and then bringing more effective tax outcomes to people who make money faster than they can figure out how to be smart with that money.
Right.
Because if we don't have life insurance, then like I say, all we have is corporate and trust structure, and that can get clunky and time consuming and expensive. You can spend a lot of money on just that when we can pair that with life insurance and have a more effective and a more immediate and a more liquid outcome. So I'm excited for all that. And then I would really love to see, I'm just going to throw it out there, I would love to see digital asset investments directly inside of life insurance policies on a consumer grade level, at market level. That would be pretty stinking cool. I think it's coming.
Yeah.
But we'll see. I'm excited.
Yeah. Well, thank you again for taking the time. If people want to reach out or, find you, I'm sure we'll have the links in the show notes below. But again, I appreciate you having the time and coming down and shooting the podcast with me.
Yeah.
And we look forward to the next one.
Awesome. Thank you for having me.
Yes, sir.